welcome to Investalk, webinar on global investments. Through this webinar, we will try to address few impending questions an investor may have when they look to diversify beyond local markets. I have with me two special guests, Mr. Bharat Parekh, Head Product and Segment at ICICI Securities, and Mr. Gavin Marriott, Investment Director, Global and International Equities, Schroders. Mr. Marriott sits within the investment team, acting as a primary interface between the team's investors and clients investing in Schroders global, international, and thematic equity funds. Welcome, Mr. Bharat and Mr. Marriott.
Welcome, Gavin, and looking forward for a great interaction.
Great. I'm delighted to be here, and thank you for giving me the opportunity.
Our pleasure. Gavin, why, according to you, an investor should look at global investing, and your view on certain key geographies that you focus on while the Indian investors move on to getting into the global markets?
I think the argument for global investing has been well made, and there is lots of academic evidence that suggests increasing your international exposure alongside domestic exposure can help you to diversify risk and to contribute to better risk-adjusted returns. The reason for that, I think, are well known to you all. It will simply be that by investing internationally, you can gain different industry exposures, you can gain different exposure to the economic cycle. And I think the other thing is that coming out of the COVID crisis for some, it will be apparent that some geographies are moving quicker in terms of normalization and recovery. And for that reason, I think it is opportune to have the flexibility to invest geographically to take advantage of different timings of recovery. So to my mind, investing internationally makes sense purely from the point of view of diversification and broadening the opportunity set. We think of global investing more, though, from a point of view of opening up the availability of companies that are open to us as investment opportunities. The broader global equity universe comprises somewhere in the order of 5,000 companies. And when we think about international investing, we think about allocating first and foremost to the best companies within global sectors rather than making a top-down decision on where to invest. So for us, it's always about the companies. It's all about finding the best investment opportunities, irrespective of where the company is either domiciled or where it chooses to list its equities.
Mr. Parekh, who all can get exposure to global markets? I mean, Indian investors are not really diversifying their portfolio. They may be within the Indian markets, but globally, if they want to have exposure, who all can get an exposure into global markets? And what does one need to keep in mind before investing?
See, today, making investment globally is much easier compared to what we might have experienced a few years back. Today, taking an exposure, the way Gavin says, is that it's all about getting a right sectors, right stocks in those sectors, and those companies may not be available in India. And they are actually the one where the innovation is happening is beyond the boundaries. And you really need to find a way to take exposure to that, because ultimately you are chasing growth and earning. And wherever you believe that the leaders are getting born, you need to be part of those geographies and those economies. As Indians, the opportunity to invest globally as multifold. You can go through a feeder fund, a mutual fund route, which will invest in one of the companies. You may pick up a fund in a Axis mutual fund, which will go and invest in a fund which is managed by Gavin, or you can pick up a fund which is investing globally in US or any of the countries. You can keep investing through our platform. So we have ICICI Direct global platform, where you can go and invest in the US companies, ETFs globally. You can go and invest into the schemes, the fixed income bonds. So today, either you use an LRS route and invest $250,000 in global market through LRS, or use a feeder fund which invests into the global markets. So there are multiple opportunities available. It has gone beyond ultra HNIs, where earlier we restricted to invest here because of the complexity, the documentation involved. Today, it's very easy for anybody to really take an exposure to international market.
Given post the pandemic, are there new exciting global themes emerging in the market? If yes, are these themes sustainable and can lead to long-term investor value?
I think there are always themes emerging, and what the COVID crisis has done is simply to accelerate a number of structural trends that were already evident in the way we lived our lives, the broader economy, and the way we were investing money. So thinking thematically has always helped to identify those areas of structural growth. The stay-at-home economy, for example, the way we increasingly use online to purchase food, apparel, the way we use online to interact. Those were trends that were already in place and have only been accelerated by the COVID crisis. There are some themes that have continued despite the COVID crisis. And there I'm thinking about themes aligned to sustainability and the environment. And what you've seen is a real acceleration in some of those themes as policymakers have sought to align recovery stimulus to and align those with environmental policies. So this shift to decarbonize the world economy, invest more heavily in green technologies, again, is another powerful theme that has simply been reinforced during the COVID crisis. The one final thing I'll reference, which again is perhaps more important than anything else, has been the importance of healthcare and healthcare innovation. And quite often it's easy to lose sight of the contribution that's made to the likely path of recovery. But you've seen within healthcare a number of these vaccines that have been really developed at such a pace using new technologies that really are demonstrating and emphasizing the value of science to drive product innovation and things that will improve all of our lives. So I think all of those things are powerful structural trends, and we need to understand how to incorporate those as investors, what it means for long-term growth, earnings power, and financial returns. And if you do it well, I think you can also benefit from strong outperformance.
Bharat, if we look at the Indian markets, we have seen a good amount of flow of FIIs coming to our country, and it has been sustainable with the kind of stimulus packages that have been announced in the last 1 year by different countries. The flow has been towards the emerging markets, including India, which has been the major beneficiary. Now, with this kind of an scenario, diversifying into global markets, how risky would it be for Indian investors, which have been earning well in this last 1 year, if you consider that?
So thanks. It is a great question, right? When the whole world is looking at you as an investment opportunity, why will you go and invest outside? You have to also consider that it is not the investments, right? It's ultimately allocation of money. A global investor is investing in India because they believe that India provides an opportunity to a market which will grow materially higher than other countries. It's a place where you will find the next round of growth. This is the place where you have a consumption. This is the place where there is a lot of underdeveloped country and lot of development which is happening. The entire policies framework is in a manner that they need to be and they want to be part of India growth story. But when I'm inside India, I have an entire exposure to India. It is important for me that if this particular trade is not going to play out, how is going to impact my overall earning and my portfolio? Hence, what Gavin speak about is a diversification is one of the most important factor why you have to look at global investing. You can't keep all your egg in one basket. Today, as an Indian investor, I have all my eggs in one basket. India growth story, India, appreciation story, India story. Tomorrow, if I have a problem, if tomorrow some of my reforms are not going to play out, if I'm going to have a currency depreciation, if I'm going to see that there are sectors which are not there in India, but they are global companies which are going to come to India and take a lion's share of part of my industry, am I better off go and take an exposure to those companies now, which will become a dominant player in India later? So if there are play available globally. The companies which are going to be a global companies, the one who are playing not only in India or US, but globally. Should that be part of my portfolio, or I play all my eggs at one place and keep it in India? So I strongly believe that there is a very, very strong reason for you to have a part allocation to a global market, which will give you a growth and which will give you a diversification.
Kevin, Axis AMC has modeled their ESG fund with inputs from Schroeder. How has Schroeder positioned their ESG fund? Please throw some light on the process and the long-term benefits of ESG as a theme.
Well, ESG is very topical at the moment, as we all will know, and Schroders has been very, very advanced in terms of ensuring we have processes to embed that within our investment approach. And at the end of last year, we set a target to ensure that 100% of the assets that we manage were managed fully integrating ESG, and we've achieved that target. We have done something quite distinct in that we have developed our own proprietary tools that are used by the investment teams in order to assess ESG. What that means is that when an analyst is looking at a stock, the analyst will also be looking at non-financial factors or ESG factors alongside the financial factors, and thinking about how those two things interact. We wanted to do that rather than relying on a third-party assessment of ESG and simply overlaying that third-party view in the context of our investment appraisal. We wanted the analyst to own both the non-financial assessment and the financial assessment. So we have developed a lot of very clever tools that allow us to do that. And we pass the responsibility for assessing ESG to the analyst. In the same way the analyst should assess the growth drivers, we want them to understand the ESG risks, and sometimes it's the contribution to returns that come from ESG as well. So I think that is the primary edge that we believe we have identified and brought into our process. It's really thinking differently. The benefit is that we are not all pursuing the same small list of stocks that are being promoted by some of these third-party ESG providers. We can think differently about ESG, differently about what sustainability means, and what that means to a company's ability to drive long-term sustainable growth. Ultimately, that's the most important thing as far as we're concerned as investors.
Bharat, any questions that you have for Gavin?
Yeah, thanks, Gitu. So, Gavin, I just to continue what you just spoke in terms of what kind of sectors, what kind of companies you are really looking for, and what kind of investments you have done in your global platform. It will just give us some insight into your thought process and how do we really look at those companies which are eligible to be part of your portfolio.
So our approach is, as I say, driven by a forward-looking perspective of companies' operating and financial performance. We're not really interested in what they've done historically. That doesn't matter. That's already been captured within returns. What matters to us is what's going to happen in the future. So for that reason, a lot of our work is spent trying to understand those long-term structural drivers that will support a profile of growth that is not yet understood by the market. The type of companies that we favor are companies where there is a profile of sustainable growth underpinned by long-term competitive advantage. So those would typically be the core compounding stocks that will continue to deliver returns irrespective of the economic environment, because they keep delivering over and over again and surprising the market in doing so. Those things that support that growth will be something like technological advantage, sustainable competitive advantage, or a structural driver of growth. So an example of the type of stock that sits in there is Amazon is a classic. Amazon has built out and grown its businesses in a way that has surprised the market year in, year out, both in terms of its e-commerce platform, but also in terms of its cloud computing businesses. And a lot of people will ask us whether that growth trajectory is recognized and priced in. And we would argue that today there is still a strong growth potential that is unanticipated by the market, coming from its international operations or its ability to monetize its customer base. Now, you think elsewhere and you look at other opportunities where there is a similar profile of return. Alibaba in China, for example, which is very similar to Amazon. Sea Limited, which is a Singaporean e-platform commerce. They also have online business, but they have a market-leading proposition in geographies such as Indonesia, Vietnam, and Taiwan. Mercado Libre, again, a South American e-commerce player with a payments platform, which again is, whilst the shares have performed well, the market still fully doesn't recognize the long-term structural growth drivers. So that's just one example of a small segment of the market where there are these long-term structural growth opportunities. The other area we focus on is where there is the potential for a near-term surprise. That might be because the market is overly pessimistic about the growth outlook or fail to miss a potential point of inflection that will cause a recovery of profits. And there you might look at the impact of the COVID crisis and the recovery in either domestic consumption, leisure travel, experiences, where again, although the market has started to anticipate that recovery, still fully doesn't expect markets in that segment to recover probably for another 2 to 3 years. And there, if we take a more constructive view that those companies can recover their earnings within the next 12 to 18 months, that represents an interesting opportunity for us. So there we would be looking at travel operators, the online travel booking site, Booking Holdings, which will see increased demand for online reservations of airline travel, restaurant, hotels, for example, or even a company like American Express, which has seen a significant negative impact on its near-term profits, because American Express relies heavily on overseas travel as a driver of its revenues. But we will start to see a recovery in those quite quickly as we start people coming out of lockdown and being able to travel again. So American Express to us gives you the opportunity to buy a great brand at a discounted price. So I think those are the types of opportunities that we're looking at today. But the point is, as the economic cycle evolves, as we start to see new opportunities emerge in different parts of the world, we will be shifting our exposure to accommodate that.
Gavin, I just on the continuation, what's your take in some of these consumption-led companies? Example, gaming companies or the entertainment companies. So I understand that post-pandemic, the Netflix of the world or the Zoom of the world may not be the preferred segment because they're overrun. But the fact is there are a lot of change, trend change in terms of consumption. Are you looking to play some of them as your portfolio companies in terms of any of those experience companies or gaming companies or any of those consumptions or a time sharing companies, whatever you call it?
Well, I think a number of the consumption plays that have performed well throughout the COVID crisis, actually there probably is a long-term trajectory of growth. So online gaming, for example, is an area of opportunity that undoubtedly will remain for some time to come. There might be an easing there might be a slowdown in the near-term growth as people start to move out of lockdown and be able to travel a bit more. But actually online gaming, in the same way that online purchasing will be with us for some time to come, I believe. I think the areas of opportunity in consumption come from the significant wealth effect that has built up through the COVID crisis. So if you have been fortunate enough to retain your job and stay in full-time employment, and you have also been at the higher end of the income spectrum, you have had a material impact on your net wealth in terms of savings, because you simply haven't been able to do anything with your income. You haven't been able to go out, spend money on holidays. And as soon as lockdown starts to ease, that will, I think, unleash a wave of spending in areas such as luxury apparel, luxury goods, hotels and travel, as we've discussed, and broader entertainment. Where we are positioned is buying stocks like Tapestry, for example. Tapestry is a US listed affordable luxury good manufacturer. They manufacture brands like Coach, for example, the handbag company. And again, there you have seen sales depressed by the crisis, but again, a good brand that could recover very, very quickly. One of the other areas of opportunity is in terms of home improvements, and home improvement has been quite strong throughout the crisis. So people have spent a lot of time at home. They've been thinking about how to renovate their properties and how to maybe upgrade their office accommodation if they're fortunate enough to have home office working. And that has fueled demand for companies like Home Depot in the US, or Lowe's, for example. There we think actually, again, this pickup in home renovation DIY can be sustained, and actually you will see over the next 2 to 3 years an ongoing demand for home improvement tools and products which will support that ongoing trend. A little less glamorous than traveling to an exotic place, spending time doing DIY at home, but nevertheless important from the point of view of driving sales growth and earnings.
And Gavin, any interesting companies which you have added in your portfolio over last 6 months or 12 months which you want to talk about? I'm sure there will be some very good examples for us to really see through what really been exciting, new addition to your portfolio.
Well, we tend to be taking a longer term time horizon when we invest. So we don't want to be trading the portfolio very actively. I mentioned American Express and C Limited were two names that we have bought recently, as we have done with Tapestry. The other areas I think of particular interest for us are the financials. And if we look at global financials, financials probably are the one area that look optically very inexpensive. And there we see opportunity to build our exposure, both in developed markets, but also emerging markets as well. So a good example of a stock that is particularly interesting to us is the Italian banking group Intesa, which again will perform well as Italy particularly, but Western Europe more broadly starts to recover, and again people start spending money and bad debt provisions start to move lower. So financials, I think, is one area of opportunity. The other area in the near term, I think, is also recognizing that unless you see a very extreme scenario over the next 12 months, you are going to see an industrial recovery as well, and that will be in the form of higher capex spend, but also opex as well. So a number of the industrial names will start to see a positive inflection in their revenues and also in their earnings. And aligned to that, it's also thinking about the implication for resource businesses. So we've been increasing our exposure to some of the energy names, companies like Equinor, which is the old Norwegian state-owned oil company, but also companies like Shell, because we do believe that we'll start to see the demand side of the equation for oil start to accelerate at a time that supply will remain reasonably stable. So again, that will put further upward pressure on oil, which will benefit many in the oil sector. Longer term, the structural headwinds for energy, though, as we start to see this shift towards renewables, I think is really very severe. And again, I don't see us holding energy names as a long-term holding within the fund.
Gavin, I have one question for you. I mean, how do you see the benchmark yield rise that we saw in US happening and impacting the global markets over, and the appreciation of the dollar against major currencies? Do you see that remaining a concern for all the global markets for some time?
Yeah, it is interesting how quickly it's moved, and that has had some serious ramifications for the market. And you've seen growth stocks, in particular those highly rated growth companies, start to derate as the market has become a bit more concerned about yields. We think that that is really signaling that we are going to go into a stronger phase of economic growth, and that actually you will start to see some upward pressure on yields, which is healthy and anticipated. We're looking for signs of inflationary pressure, and although we see pockets of inflationary pressure in certain sectors of the market, for example, in semiconductor prices and in software more broadly, actually the inflationary pressures that we see at the moment are not signaling too much risk, but it has introduced a change in the market dynamics, really, that you can date back to the latter part of last year as more confidence about the path for recovery. We're positioned in a way that we've reduced our exposure to growth companies within the portfolio, down from being overweight to broadly in line with the benchmark index, and reflecting a positive view about the economic recovery. We've actually rotated into some of the value areas of the market. I referenced financials and materials and energy as an area of interest. So we've rotated into value. So we're broadly in line with the benchmark index in terms of our style exposure, which means that we're going to be reasonably agnostic about the market environment. In terms of currency is always difficult to call. We tend to look at spot rates as an indicator of the impact of currency on flows and of profits. But at current levels, I think we believe that actually dollar weakness is likely to remain. And again, that bodes well for a sizable tactical allocation to the emerging markets and also Europe, which will benefit from that cyclical recovery as well as dollar weakness.
Bharat, for the Indian retail investors or the institutional investors who would be going for the global exposure, how is currency risk being, how does currency risk be handled, in such circumstances if we go for global markets? Also, do we need a special RBI approvals for getting into global markets?
The 2 points, Gitu. The first, in terms of the currency risk, ultimately, we are looking at global investment as a part of a diversification. And hence, the idea here is that are we putting part of our exposure outside INR? And I think there, if you are taking an exposure to, say, a US or any of the European countries' equity market, currency depreciation or appreciation to a large extent get adjusted through the prices. So if the currency is going to depreciate or appreciate, it will also get reflected in the earning and the profitability of that company. And it will get adjusted through the price of the company. So as far as you're not moving money from one currency to another currency in cash, where you broadly don't have an earning potentials, then obviously it will become more like a currency exposure. But in a diversified portfolio construct, if you look at an exposure outside India and you're investing into a particular company which is a growth oriented or a value oriented, as the case may be, but ultimately you're buying into a business, and then you are taking an exposure to that particular country or that particular company. A lot of these American companies or the large corporates are actually well diversified global corporates, and they really have a lot of exposure across the geography in terms of the currency. And broadly, these kind of a global currency or global companies don't give you that kind of a currency exposure to a single currency exposure the way we have it in India. So when we look at a diversification, it actually also removes a risk of a single currency exposure. As far as investment in global market is concerned, from the individual point of view, there is a $250,000 of limit. 250K, Gavin, in your language, is the limit which Indian government has placed for an individual to invest in a global market through automatic route, which is called LRS. Whereas if you really, as a corporate, want to invest, obviously there are restrictions available around them, that what you really want to invest and why do you really want to invest. But what we have seen is that global corporates or the Indian corporates are not the one who's looking for a global investments. Who's looking at is an ultra HNI or an HNI or an individual retail investor who's really want to take an exposure and diversify his risk. And there, I think 250K is a decent amount of limit available annually. So if somebody wants to invest today, in month of March, he can invest 250K. Again, in April, he can invest 250K because it's a financial year limit. So broadly, if somebody wants to really invest, I think he can invest $500,000 in next 1 month without taking any approval.
All right. Thank you, Gavin and Bharat, for being with us. Thank you for your time. Indeed, a pleasure to speak with you, and I'm quite sure our discussion here today will definitely help the viewers in understanding global investments better and take an informed decision to look at the global diversification in their portfolio. Thank you once again.